Many business owners believe a cash flow problem is solved when the bank balance finally starts recovering. They collect overdue invoices, reduce unnecessary spending, postpone a few purchases, or generate additional sales. In this video, we are sharing 5 common reasons why cash flow problems keep coming back again and again. Number 1. Revenue mismatch problem. The first problem begins with a distinction every business owner should understand. Revenue and cash are related, but they are not the same thing. A business can generate strong revenue during a month without receiving all of that money during the same month. Imagine a company generates $100,000 in sales. On paper, that looks healthy, but suppose only $60,000 actually reaches the bank account this month. The remaining $40,000 exists in unpaid customer invoices that may not be collected until later. Now consider the other side of the business. Payroll still arrives on schedule. Rent has a deadline. Suppliers expect payment. Insurance, software, utilities, marketing, inventory, taxes, and other operating costs continue requiring actual cash regardless of when customers pay. The result is a financial mismatch. The company may have enough revenue to cover its expenses on paper, but it does not have enough available cash at the moment those expenses need to be paid. This is where a profitable-looking month can still produce financial stress. The problem becomes more interesting when management responds by increasing sales. More sales sound like the obvious solution to a cash shortage. But if those additional sales follow the same payment structure, the company may simply create even more revenue that has not yet become usable cash. Suppose monthly sales grow from $100,000 to $150,000. Supporting those additional sales may require more inventory, more labor, more shipping, additional contractors, or increased marketing. Those costs can appear before the company receives payment from its new customers. The business is now spending today's cash to create tomorrow's collections. Sales are rising, customers are increasing, and the income statement may look stronger. Yet the bank account can become weaker because the company is financing the gap between delivering value and receiving payment. This is why recurring cash shortages cannot always be solved by chasing more revenue. Management needs to understand how revenue converts into cash. The important questions are not only how much the company sells, but when customers pay and how much cash must be spent before that payment arrives. A stronger system tracks sales and collections separately. Management should know how much revenue was generated, how much cash was actually collected, how much remains in accounts receivable, and when that outstanding amount is expected to arrive. Number 2. Growth momentum problem. Growth is usually treated as evidence that a business is becoming stronger. More customers, larger orders, additional locations, new employees, and higher sales all look positive. But financially, growth has an uncomfortable characteristic that many owners discover too late. Growth often requires cash before it creates cash. Imagine a small product company suddenly receives twice as many orders as usual. The owner celebrates because demand is growing, but fulfilling those orders may require purchasing additional inventory immediately. The company spends more cash before customers have even received the products. The same pattern appears in service businesses. More clients may require additional employees, contractors, equipment, software licenses, office space, or marketing. Payroll may begin immediately, while revenue from those new customers might not be collected until several weeks later. This creates what we can call the growth momentum problem. Once growth begins, the company develops financial momentum. Every new level of sales creates another level of operating requirements, and those requirements can continue pulling cash forward faster than the business replenishes it. The dangerous part is that management may interpret the pressure incorrectly. Because demand is strong, the company appears successful. Owners may assume the temporary cash shortage will naturally disappear as revenue increases. Instead, they continue expanding and create another layer of expenses. Consider a business that hires 5 employees to handle rising demand. Those employees create recurring payroll obligations. The company may also need additional computers, software, training, insurance, and workspace. One growth decision has now created several new cash commitments. If sales continue rising, those commitments may be perfectly manageable, but if customer payments arrive slowly or growth suddenly levels off, the company is left with a larger cost structure. The revenue momentum can slow much faster than fixed expenses can disappear. This explains why some rapidly growing businesses repeatedly experience cash emergencies. They solve one shortage, expand again, encounter another shortage, find additional financing, and repeat the process. Growth itself is not the problem. Unfunded or poorly timed growth is the problem. A healthier approach is to calculate the cash requirement of growth before committing to it. If the company wants to increase sales significantly, management should estimate how much additional inventory, payroll, marketing, equipment, and working capital will be required before the new revenue becomes cash. Growth should therefore have a financial plan, not just a sales target. The question should not only be, how much can we grow? It should also be, how much growth can our current cash position safely support? That distinction can prevent success from becoming the next cash flow problem. Number 3, customer timing problem. Customers do more than determine how much revenue a business generates. In many companies, customers also determine when that revenue becomes cash. This gives customer payment behavior enormous influence over the company's financial stability. Imagine a business has 10 reliable customers. Every customer eventually pays, so management assumes there is little risk. But several customers consistently pay 30 or 40 days after receiving an invoice. The money is coming, but the company cannot use money that has not arrived yet. Meanwhile, the company's own obligations do not automatically move with customer payments. Employees cannot always wait an extra month for payroll. Landlords do not usually adjust rent because an invoice is late. Suppliers may also have payment terms that are shorter than the terms offered to customers. This creates a timing imbalance. Customers effectively control the speed of incoming cash, while the business has much less flexibility over outgoing cash. Even when every customer eventually pays in full, the difference between those schedules can repeatedly create shortages. Large customers can make this problem even more surprising. Winning a major corporate client may dramatically increase revenue, but that customer may negotiate longer payment terms. The business could therefore become more dependent on a customer that also keeps a larger amount of its cash outside the company. For example, a small supplier may need to purchase materials, pay employees, manufacture products, and deliver an order before sending the final invoice. If the customer then takes another several weeks to pay, the supplier has financed almost the entire transaction using its own cash. Now, imagine this happens repeatedly. The business receives one large payment and feels financially comfortable. It immediately begins fulfilling the next group of orders, cash leaves again, and the bank balance falls. Another customer payment eventually arrives, temporarily restoring the balance. From the owner's perspective, cash flow appears unpredictable. In reality, the company may be following a predictable cycle created by customer timing. The problem keeps returning because the business is repeatedly financing customers between the moment work begins and the moment payment arrives. This is why accounts receivable should not be treated as an administrative detail. It is part of cash flow management. Businesses should understand average collection time, overdue invoices, customer payment patterns, payment concentration, and how much working capital is tied up waiting for customers. Depending on the business model, deposits, progress payments, automated reminders, immediate invoicing, clearer payment terms, electronic payment options, And disciplined collection procedures may reduce this pressure. Even small improvements in collection timing can release cash that was already earned but unavailable. The goal is not to pressure good customers unnecessarily. The goal is to create payment terms that work for both sides. A sale is valuable, but a business must survive financially between making that sale and collecting the money. And this leads to an even deeper cash flow problem. Sometimes customers are paying, revenue is growing, and the business is reporting a profit, yet the bank account still remains surprisingly weak. That is where the difference between earning profit and actually converting that profit into cash becomes critical. Number 4, profit conversion problem. This brings us to one of the most misunderstood financial situations in business. A company can report a profit and still struggle to maintain enough cash. Profit measures financial performance under accounting rules, while cash tells you how much money is actually available to operate the business. Imagine a company reports $50,000 in profit for the quarter. The owner sees that number and assumes the business has created $50,000 of additional financial strength. But that does not necessarily mean another $50,000 is sitting in the company's bank account. Part of that profit may be connected to sales customers have not paid yet. Another portion of available cash may have been used to purchase inventory. Money may also have gone toward equipment, loan principal, taxes, or other obligations that affect the bank account differently from accounting profit. Inventory provides a simple example. A business can spend $20,000 purchasing products that will be sold over the next several months. That money has not simply disappeared. It has been converted from cash into inventory, but cash sitting on a shelf cannot be used to make payroll tomorrow. Accounts receivable creates a similar situation. The business may recognize revenue after delivering a product or completing a service, but the customer might pay later. The sale can contribute to accounting profit before the corresponding cash reaches the company's bank account. This creates the profit conversion problem. The business is successfully generating accounting profit, but that profit is not converting into available cash quickly enough. The owner sees positive financial results while simultaneously experiencing pressure when actual payments need to be made. The problem can become worse when owners make spending decisions based entirely on reported profit. A profitable quarter may encourage new hiring, equipment purchases, larger owner distributions, expansion, or additional marketing. Those decisions require actual cash, not accounting profit. Suppose the company reports strong annual earnings, and the owner decides to withdraw a significant amount of money. Shortly afterwards, several large invoices remain unpaid while payroll, taxes, and supplier bills arrive. The profitable company suddenly experiences another cash shortage. Nothing mysterious happened. The business simply committed cash that was needed elsewhere because profit was treated as if it were immediately available money. This is why financially disciplined companies examine profit and cash flow together rather than using one as a substitute for the other. A useful question is not simply, did we make a profit? Management should also ask, where did that profit go? Some may be sitting in receivables. Some may be tied up in inventory. Some may have funded assets, debt payments, taxes, or distributions. Following that, movement helps management understand the quality of its profit. A business that consistently generates profit and converts a healthy portion of it into operating cash is financially different from a company whose reported earnings remain trapped in working capital. The solution begins with regularly comparing the income statement, balance sheet, and cash flow statement. Together, these reports help explain what the company earned, where its resources are located, and how cash actually moved through the business during the period. Owners should also become cautious about expanding spending simply because one report shows strong earnings. Before making a major financial commitment, the business should examine current cash, upcoming obligations, expected collections, inventory requirements, taxes, debt payments. and a reasonable cash reserve. Profit remains extremely important. A business cannot build long-term financial strength without eventually generating sustainable profits. But profit becomes much more useful when the company has a reliable system for turning those earnings into cash it can actually control. Number 5. Cash cycle problem. The final problem connects many of the previous problems together. Every business has a cash cycle. Money enters the company, moves through operations, becomes products or services, reaches customers, and eventually returns as cash from completed sales. The important detail is that this cycle takes time. A business may spend cash on inventory today, sell the product later, send an invoice after the sale, and then wait again for customer payment. Cash leaves at the beginning, but may not return until much later. Imagine a wholesaler purchases $50,000 of inventory. The supplier requires payment within a relatively short period. The wholesaler then stores the products, sells them to retailers, and gives those retailers additional time to pay their invoices. The company has created a gap between paying for inventory and collecting from customers. During that gap, it still needs cash for payroll, rent, transportation, insurance, utilities, and other expenses. The longer the gap becomes, the more working capital the company needs. Now imagine the business successfully completes the cycle and finally collects its customer payments. The bank balance increases, creating a feeling of financial relief. But almost immediately, the company needs to purchase another round of inventory and begin the cycle again. This is why cash problems can appear to disappear and then return on a predictable schedule. The business receives cash at the end of one operating cycle and consumes it at the beginning of the next. Without enough working capital, every new cycle recreates the same pressure. Service businesses have cash cycles too. A consulting company may hire employees and pay salaries throughout the month, complete client work, send invoices afterward, and wait for payment. The company is effectively funding the service before receiving the customer's cash. Construction businesses can experience an even longer version. Materials may need to be purchased, subcontractors paid, equipment rented, and workers compensated while a project is still underway. If customer payments are tied to later milestones, significant cash can remain committed for extended periods. The cash cycle problem becomes more dangerous as the business grows. A larger company may have more money moving through the cycle, but it may also have significantly more cash trapped in inventory, unfinished work, and accounts receivable at any given moment. This explains an important business finance principle. Growth does not automatically shorten the cash cycle. If the underlying process remains inefficient, growth may simply make the same cycle larger. More revenue then requires more working capital to keep everything moving. Improving the cash cycle means examining every stage where money becomes delayed. How quickly does inventory sell? How soon after completing work does the company invoice customers? How long do customers take to pay? When must suppliers be paid? Even small improvements can compound. Faster inventory turnover can release money sooner. Immediate invoicing can start the collection process earlier. Better collection procedures can reduce waiting time. Carefully negotiated supplier terms can give the business more breathing room before cash leaves. The objective is to reduce the amount of time the company's money remains trapped between spending and collection. The faster cash can complete the cycle and return to the business, the less outside financing or emergency cash the company may need to support normal operations. If you found this video helpful, then like, share, and subscribe this channel to get future videos. Thank you for watching this video.